All right. The learner, we're back, and this time we're diving into something pretty big.
Yeah.
Um, you sent in a very, very detailed report on India's proposed direct tax bill 2025,
Right.
which big change, if it goes through, would completely replace the Income Tax Act of 1961.
Wow.
So we're talking about replacing something that's been around for decades and decades and decades.
Yeah, absolutely.
And what we're going to do today is try to cut through all the legal jargon
Sure.
and really get to the heart of what matters most to you.
Yeah.
What are the key changes that are going to simplify things,
Right.
modernize the tax system, and maybe even throw in a few surprises.
Interesting.
So we'll look at the reasons behind this big overhaul, what's driving it, the major structural changes that are being proposed,
Okay.
key amendments that affect how different types of income are taxed,
Mm-hmm.
and of course how this bill aims to change the way taxes are collected and how disputes are resolved. So think of this deep dive as your personal guide to understanding this very important piece of potential legislation.
Right.
So let's jump right in. One of the first things that struck me was, why replace such a well-established act in the first place?
It's interesting because while the 1961 Act has seen a lot of updates over the years,
Yeah.
it has become, pretty complex.
I see.
And that complexity has led to, a lot of litigation, a lot of people ending up in court over tax issues.
Right, right.
And so this new bill is really about simplification.
Okay.
It's about, trying to reduce those disputes by making the tax system easier to understand and follow.
Yeah, that makes sense.
And it's also worth noting that the government has actually taken a pretty consultative approach this time around.
Okay.
They sought input from various stakeholders while drafting this bill.
So trying to make it, kind of from the ground up a collaborative effort. Okay, so we're talking about simplifying, reducing disputes. So that means there are some pretty significant structural changes happening.
Oh, yeah, definitely.
What are some of the big ones?
Well, one of the most striking things is just the sheer reduction in size.
Oh, wow.
The bill goes from 47 chapters down to 23.
Wow, that's a huge reduction.
And the number of sections is cut in half.
Really?
From 819 down to 536.
That's incredible.
This is a much leaner document.
Yeah.
But interestingly, the number of schedules has actually gone up a little bit from 14 to 16.
Oh, okay. So they're adding more details in the schedules.
Exactly. So it seems like they're trying to streamline the core law itself.
Yeah.
Make it more concise and then put more of the detailed specifics into those appendices.
I see. So it's kind of like separating the main principles from the nitty-gritty details.
Yeah, exactly.
That's a really interesting approach.
Yeah, and another big change you'll notice is that some familiar terms are going away.
Oh, like what?
Like previous year and assessment year. Yeah, they're gone. They're introducing a unified tax year.
So everything's aligned now.
Yes, it runs from April 1st to March 31st.
Okay, so it matches the financial year.
Exactly. Much simpler.
Makes sense.
And, they're also making an effort to use clearer language.
Good.
Replacing legal jargon with more everyday terms.
Right.
For instance, instead of using notwithstanding, they'll use irrespective of.
Okay.
And there's a focus on using more user-friendly tables and formulas,
Yeah, that's helpful.
especially for things like, salary perks, presumptive tax TDS rates.
So it's all about making the information more accessible.
Yeah, absolutely.
So those are some pretty big picture changes. But let's zoom in a little bit now and talk about how this bill could actually affect people's wallets.
Okay.
So, different types of income are treated differently under the tax law.
Right.
And it looks like there's some significant changes coming for each category.
Yeah, there are.
So let's start with salaries. It seems like they're trying to take a more consolidated approach here.
Yeah, that's right. All the provisions related to salary income are now being grouped together into a single section.
Okay.
So it's all in one place, which should make it easier to understand.
Right, right.
And one important thing to note is that income for partners in a firm is not considered salary under this bill,
Okay.
which aligns with current practice.
But no change there.
No change there. And as we mentioned earlier, they're planning to use more tables and formulas to make it easier to figure out your deductions and all that.
Good.
So yeah, salaries are getting a simplification treatment.
Okay, so let's move on to house property income.
All right.
Now, this is something that affects a lot of people.
Yeah, it does.
So what are the big changes there?
Well, one of the most notable changes is that the rules for self-occupied property are being relaxed.
Really?
Yeah. You can now designate up to 2 properties as self-occupied
Oh, wow.
without those previous location-based restrictions.
Well, that's a big difference.
Yeah, it is. And the way annual value is calculated is also being revised. It'll be the higher of the expected rent or the actual rent you receive.
Okay, so if you're letting out the property, it's based on what you actually get.
Exactly.
And if it's vacant, it's based on what you could potentially get.
That's right.
Nope.
But one thing that's staying the same is the 2 lakh rupee annual limit on interest deduction for loans on self-occupied properties.
Okay.
And that's still tied to that 5-year construction or acquisition timeline.
So you have to finish building or buying the house within 5 years of taking the loan
That's right.
to get the full deduction.
That's right. And also important is that the amount of loss from house property that you can set off against other income
Yeah.
is being capped at 2 lakh rupees per year.
Oh, I see.
On the other hand, developers are getting some relief.
Okay, how so?
They're going to have a NIL annual value for unsold flats or commercial units
Oh, wow.
that are held as stock for 2 years after they get the completion certificate.
So that's a big incentive for developers to, kind of keep those properties on the market.
Yeah.
Okay, so that's house property. Lots of interesting changes there.
Yeah, a lot going on.
Now, what about income from business or profession?
All right.
Any key shifts there?
Yes, definitely. One thing is that the definition of business connection in India is being made more explicit
Okay.
and broader, basically saying that if you're doing business in India,
Yeah.
you have a business connection here. So that's pretty straightforward.
Mm-hmm.
And there's also a wider scope for export incentives,
Okay.
which is good news for businesses that are, selling their goods or services overseas.
Mm.
And they're clarifying the treatment of mark-to-market losses.
Okay.
So those will be deductible,
Good.
but not under other provisions.
Okay, I see.
And here's a key point for businesses. The GST that you pay on an asset's cost won't be included in the asset's value for tax purposes.
Okay.
If you claimed input tax credit.
Oh, so that's a benefit.
Yes, it is.
Okay.
And it's interesting, non-residents providing services to Indian electronic manufacturing businesses might fall under presumptive tax and audit rules.
Okay. So that's a new thing to consider.
Yeah, it is. And the tax breaks for units in IFSCs.
International Financial Services Centers.
Yes, those are being extended until March 31st, 2030.
So they're continuing that.
Yeah, they are.
Okay, so that's business and professional income.
Yeah.
What about capital gains?
Right, capital gains, this is where things get interesting.
Yeah, because this is often where people have a lot of questions.
Right, right.
So what's changing?
Well, for one thing, undisclosed income in search cases will now include virtual digital assets.
Also cryptocurrencies and things like that.
Exactly.
Okay.
And tax authorities are going to have greater access to digital information.
What do you mean?
During searches, they'll be able to look at things like emails, social media accounts, trading accounts.
Okay, so they're kind of getting more tools to track things down.
Yeah, you could say that, and this is important, any income from transferring capital assets that are located in India will be considered to accrue in India.
Okay, so even if you're not a resident,
Right.
if you're selling property in India, you're going to be taxed in India.
That's the idea.
Okay.
Now, here's a major shift. They're removing indexation benefits
Wow.
for properties that are acquired after July 23rd, 2024.
Okay, so that's a big change for long-term investments.
It is. It means that when you calculate your capital gains, you won't be able to adjust the purchase price for inflation.
I see. So that could lead to higher tax liability.
Yeah, potentially. And another big one, the capital gains exemption that you can get by reinvesting your profits under Section 54,
Yeah.
that's being capped at 10 crore rupees per transaction.
Okay, so there's a limit now.
Yes, there is.
Okay.
Now, for joint development agreements, JDAs, the taxation is being deferred until the year that the completion certificate is issued.
Oh, okay. So that makes things a bit more clear.
It does. And for rental income from vacant property, they're going to tax it based on the expected value, not the actual rent you might receive.
So even if you're not getting any rent, you could still be taxed.
That's right.
Okay.
But here's some good news. The annual investment limit in capital gain bonds.
Under Section 54 EC.
Yes, that's being increased to 54 UPIs.
Oh, that's a significant jump.
It is. And just to make things a little bit neater, all the capital gains related provisions are being consolidated
Okay.
under specific clauses.
So they're all in one place.
Yes, much easier to find.
Okay, so a lot to unpack there with capital gains.
Yeah, for sure.
All right. Let's move on to TDS and PCS.
Right.
tax deducted at source and tax collected at source.
Right.
It seems like this whole system is getting a makeover, too.
Yeah, it is. They're really trying to simplify and streamline the whole thing.
Good.
So most of the TDS provisions,
Yeah.
except for salaries,
Yeah.
are being consolidated into a new Section 393.
Okay.
And they're going to present it in a tabular format.
Well, that's nice.
Yeah, much easier to read and understand.
And what about TCS?
Same thing. They're putting all those provisions into Section 394 in a table.
So they're really emphasizing clarity and ease of use.
Exactly. And there's an expansion of the rule for deeming TDS on credit to suspense accounts.
Okay.
And the CBDT, the Central Board Direct Taxes,
Yeah.
they're going to have more authority to issue guidelines.
Okay, so more flexibility for them.
Right. And you're right. The threshold limits for TDS in various sections are also going up.
From April 2025.
Yes. So that means less compliance burden for some people.
Good.
Yeah.
Okay, so we've talked about how different types of income are being affected. We've
Yeah.
talked about TDS and TCS.
Mm-hmm.
But what happens when there are disagreements or issues?
Yeah.
How is dispute resolution changing under this bill?
Well, faceless assessment is here to stay.
Okay, so that's continuing.
Yeah. And the government is going to have the power to introduce new schemes
Okay,
to make the process even more efficient and transparent.
good.
And this is important. The DRP, the Dispute Resolution Panel,
Yeah.
they're going to have to issue reasoned orders.
So they have to explain their decisions.
Exactly. No more just, one-line rulings.
Oh, that's good for clarity.
Yeah, it is. And taxpayers are going to have a lot more time to file updated tax returns.
Really?
Yeah, the deadline's being extended to 48 months.
Wow. From 12 months.
So 4 years.
That's a big change.
It is. It gives people a lot more breathing room.
Yeah, that's great. And just to be clear, this direct tax bill also incorporates all the changes that were proposed in the Finance Bill 2025.
Yes, it does.
So it's kind of like the whole package.
Exactly.
So just to recap those key changes from the Finance Bill that are now part of this bigger bill.
Okay.
We've got the new tax slab structure under the new regime.
Right.
The increased rebate under Section 87A for those opting for the new regime.
Mm-hmm.
The relaxed rules for deemed let-out property.
Yes.
Allowing up to 2 self-occupied properties.
Right.
The removal of Sections 206AB and 206CCA.
Mm-hmm.
And the new treatment of high-premium ULAPs as capital gains.
It's all in there.
Okay, so it's a very comprehensive bill.
Very comprehensive.
And finally, it looks like they're also taking the opportunity to clear out a lot of old, unnecessary parts of the law.
Oh, yeah, absolutely. They're getting rid of a bunch of outdated sections,
Right.
like the ones dealing with investment allowances and fringe benefits tax.
Okay.
Things that are no longer relevant.
So they're doing some house cleaning.
Exactly. And they're also removing a huge number of explanations and provisos.
Wow, how many?
Like around 900 explanations and 1,200 provisos.
So that's going to be the law much shorter.
Yeah, much more concise. And even the definition in Section 47 is being updated.
Okay.
They're removing clauses that are no longer needed.
So it's really a top-to-bottom overhaul.
Absolutely.
So the learner, as you can see, this proposed direct tax bill is a major reshaping of India's tax system.
It is.
It's about simplifying, modernizing, and creating a more transparent framework.
Yeah, I think that's the overall goal.
And what's really interesting is the focus on making the law itself easier to understand. They're using simpler language, they're using tables and formulas, they're getting rid of outdated provisions.
Right.
So it seems like they really want to make tax less daunting for the average person.
Yeah, I think that's a big part of it.
Now, of course, there are some big changes that could have a significant impact on your finances.
Yeah.
Things like the removal of indexation for newer properties and the on capital gains exemptions.
Those are big ones.
So it's really important to think about how these potential changes might affect your long-term investment strategies.
Yeah, definitely something to consider.
And the extended time frame for updated returns gives you more time to make adjustments if needed.
Right.
So the learner, this is a developing story.
Yeah, it is.
This bill is still under a review, so there might be further modifications.
Yeah, absolutely.
But it's definitely something to keep an eye on.
It's going to shape India's financial landscape in the years to come.
Absolutely. So stay tuned. We'll keep you updated on any major developments.
Sounds good.
Thanks for joining us, The Learner.
Bye.